Hey, it's Travis from SLP Wealth. Are you saving money or costing yourself money managing your own investments? I built a spreadsheet for it. Let's dive in and find out. All right, so first off, the key for this spreadsheet. If something's green, it's low risk of not doing this action. It means you're probably going to be able to do this fine when investing. Yellow means that you may or may not do this. A lot of people don't take the action that is highlighted in yellow, and then red is there's a very high risk that if you invest on your own, you won't do this. So these are this series of investing mistakes a lot of people make. And this column right here, basically what you do is select, are you doing this or will you do this, yes or no? And so you want to look through each one of these and decide if it's yes or no based off of your individual circumstance. So for investing in a low-cost way, we pulled some data from MIT and Vanguard research papers that estimate what is the annual performance impact of mistakes that individual investors make in an annual basis on their portfolio returns. That's where we pulled this data right here from. So investing in a low-cost way, can you choose index funds? Can you choose low-cost funds? At the end, most people are going to be able to do that, which is why it's highlighted in green. So select yes if you're able to do that on your own. Avoid market timing. This is the one that creates the most not fully truthful people in their responses. The reason I say that is because most people market time. And market timing is not just going from stocks to cash in a recession. It's also increasing your contributions when the market's good, decreasing recurring contributions when the market's bad, and putting more money into hot asset classes when they're hot and less money into cold asset classes when they're cold. So most people, if they're honest, would say, are you going to remember to do this? No. Most people would say no. But let's give that to us and let's say that yes, that people will avoid market timing. This one is practicing tax-efficient asset location. So what this basically means is if you put any money in international stocks, are you putting more international stocks in your retirement where it's tax-deferred growth because of the higher dividend yields on international stocks? And then are you putting fewer international stocks in your brokerage account and more U.S. stocks in your brokerage account where the tax efficiency matters more? Are you putting your taxable bonds in retirement, tax-free bonds in your brokerage? Are you practicing smart asset allocation between growth and value? Are you practicing smart asset allocation between active and passive if you have active and passive mutual funds or ETFs? All of these things matter a lot. Are you putting your real estate investment trusts in the right place in retirement instead of brokerage? So a lot of people will fail to do this, but let's, again, just pretend that somebody says, yes, I do this. Now, here's the one where people really just don't do this. Engaging in tax loss harvesting. Some people that use robo-advisors have this, but the problem is you have to do tax loss harvesting across all accounts, not just some, meaning that if you have a bunch of total stock market index funds in an IRA, that could create a wash sale for tax loss harvesting you're doing in your brokerage account. So you have to be looking across your entire portfolio and making sure that you're following the wash sale rule, which most people do not do. So most people, if they're honest, would have to select no for this answer. Managing cost basis. This is another one that even the most hardcore DIYers really fail to do this. Did you know that at Vanguard, the default cost basis is first in, first out for stocks and ETFs and average cost for mutual funds? What does that mean? It means that you will be realizing a ton of unnecessary taxes if you ever go and sell if you don't know what you're doing and you're not actively managing your cost basis. Furthermore, if you're giving anything to charity at all, you want to be making sure you donate the stocks and mutual funds with the largest gains in your portfolio. If you're not doing that, you're costing yourself money. That is not a good thing to do, but most people end up doing this, so most people would need to select no for this particular answer choice. Now, rebalancing. If you have any asset class besides U.S. stocks in your portfolio, are you putting more money into asset classes that have been underperforming to get it back to the target allocation? Are you managing your rebalancing at least once a year? That mostly adds risk protection to your portfolio more so than returns, but there is some amount of return benefit to that as well. So if you sum up these three red ones, you're getting value add of up to 2.2% roughly per year. So then how much would you be paying an advisor? So over here you put in how much you have in investments. Let's say it's $100,000 and you're putting $10,000 a year into those investments on a recurring basis. Let's say you're still working and that you're 35 years old and that you're going to retire at 65. Now, if you put in your expected rate of return, you type in the type of fee you're paying an advisor. There's obviously multiple different ways to pay an advisor. So you can put in the fee there and you can see the potential value add based off of this amount of investments and recurring contributions over 30 years net of fees. We've got the detailed numbers here below. You can see the portfolio value assuming zero mistakes are made, the potential portfolio value assuming you have professional management, minus the fees paid for that management, and then the potential wealth that you have, assuming you make all those mistakes, but you don't have any fees for investment management. So the value add is simply taking the cost of the mistakes minus the advisory fee. So thinking about these numbers, a lot of times someone thinks, oh, 1% AUM is a waste of time. Well, what often happens is, let me put in yes to all of these. So we're not looking at, we're pretending that somebody does not, an advisor adds zero value, basically, is what I'm tricking the spreadsheet to do. If an advisor provides zero value, you can see up to 0% value add. Well, then now the expense is just an expense. So if you're paying an expense with no value, then there's no benefit whatsoever for that AUM fee, or any fee whatsoever. But if you have an advisor that helps you avoid market timing, there's suddenly a positive ROI. Now, what if that AUM fee is really high, 1.5%? Well, your AUM fee is offsetting the benefit of market timing. What if it's 1.25? Then there is, oops, not 125, haha, 1.25. Then there's a little bit of a value add. So that, if you think about it, that kind of makes sense. There's a lot of high fee advisors out there that pretty much the only value add they have in many cases is helping people avoid market timing, because they don't do tax loss harvesting. They don't help people manage the cost basis carefully. They don't pay attention a lot to rebalancing. There are some advisors out there like that. And so, a lot of times people are looking at those advisors that add no value and saying, hey, look, AUM is a big expense, or, even paying a flat fee per year, $10,000 a year, is a really big expense, right? And the reality is, what you can see here is a flat fee that's high. It could be a lot more expensive than a 1% AUM fee, depending on the amount of money that you have. So it's just important to actually look at the math behind things, to have a sober-minded analysis about what mistakes you would actually make. And I think it's important to be honest with yourself. Like, if you have not been doing tax loss harvesting, you're not going to wake up tomorrow and start doing it. If you have been selecting the wrong cost basis, if all of your cost basis selection methods at Vanguard, Fidelity, or Schwab are the default method, then that is a big red flag. You can't just go change that and assume you're never going to make that kind of mistake again. It's probably pretty likely that you will. If you have not been rebalancing, that's not something that you're going to keep track of. If you, are buying real estate investment trusts in your brokerage account, or you are putting, or you have a lot of money in savings where you're paying ordinary income tax on large amounts of savings in a savings account, that is suboptimal, right? If you increase your contributions when the market's going well, and you kind of slow down contributions or get really conservative and increase cash holdings in a market downturn, that's market timing. It's not fun to admit that people market time, but most people do. So that's what a high value advisor is supposed to do, is add value over and above their fee. Not everybody does it, but I think that if you think about the tax loss harvesting, the cost basis management, the regular rebalancing, and if you're honest, somebody that's going to push back on market timing and keeping an allocation that makes sense, there can be an enormous amount of value added regardless of what kind of fee you're paying. If it's a flat fee, an AUM fee, a hybrid, or whatever, there can be a lot of different ways to add value as an advisor, and it all depends on mistakes that you will or will not make. And if you need help with investment management, SLP Wealth would love to help you. All you need to do is reach out to your SLP Wealth financial planner and get the process going of talking about how we can help you meet your financial goals faster. SLP Wealth is a registered investment advisor, and of course, nothing in this video should be construed as a guarantee of investment performance, and all investments are subject to risk, and past performance is no guarantee of future results. Fun legal stuff, but reach out to your planner. Just ask your SLP Wealth financial planner if you want our help to make sure that you don't make these mistakes, so that you can get more on track for your financial goals and dreams.